356 to 1. That is the number of paper ounces of silver that exist for every single physical ounce sitting in a vault right now. And after what just happened on January 29th, that number may have just become the most dangerous statistic in global finance. Before we get into this, where are you watching from right now? Is it 2 in the morning and you cannot sleep because your silver portfolio just took a 40% hit? Are you refreshing the spot price from Tokyo, from London, from your kitchen table in Texas? Drop your city in the comments, because what I am about to show you affects every single person holding physical metal or paper contracts anywhere on Earth. Now, if you are new here, subscribe for daily silver and gold market intelligence. We are running a real-time news desk covering the most volatile precious metals market in 45 years. Hit that subscribe button because you do not want to miss what is coming in March. Let me set the crime scene for you. Silver is trading right around $79 per ounce today, February 13th, 2026. Gold is hovering near $5,000. The gold to silver ratio sits at roughly 63 to 1. But here is what the viral video you probably just watched did not tell you. That chart analysis, those Fibonacci levels, the technical patterns, none of that matters if the entire system the price is built on is a house of cards. And I'm about to show you the math that proves it is. The video you watched told you silver crashed. It told you algorithms triggered. It even threw out the number 365 to 1 paper contracts per physical ounce. But it never explained what that number actually means. It never told you why it matters. And it definitely did not tell you what happens when that ratio breaks. That is exactly what we are going to do right now. And what I found when I dug into the COMEX delivery data is going to change how you think about every ounce of silver you own. Let me explain how this system actually works, because most people get it wrong. COMEX is the commodity exchange run by CME Group. It is where the global price of silver gets discovered through futures contracts. Each contract represents 5,000 ounces of silver. But here is the critical part. Most of these contracts never result in actual physical delivery. Traders buy and sell paper promises. They roll contracts forward. They settle in cash. The entire system operates on one assumption. Nobody asks for the real metal all at once. Think of it like a bank. Your bank does not keep everyone's cash in the vault. It lends most of it out and keeps a fraction on hand, because statistically not everyone shows up on the same day demanding their money. COMEX works the same way, except instead of dollars, they are fractionally reserving silver, and the fraction has gotten insane. Here are the numbers as of early February 2026. COMEX registered silver inventory, that is the metal actually tagged and available for delivery against futures contracts, has collapsed to approximately 103 million ounces. That is down from 167 million ounces just 4 months ago in October 2025. That is a 38% decline in 16 weeks. They are draining roughly 785,000 ounces per day. Now here is where it gets terrifying. The March 2026 silver contract alone represents over 400 million ounces of theoretical delivery obligations. Some estimates put it between 425 and 455 million ounces against 103 million ounces of registered silver. That is a ratio of over 4 to 1 for a single contract month. But zoom out further. Total COMEX silver warehouse stock, including eligible inventory, sits at around 381 million ounces. But eligible does not mean available. Eligible silver is metal sitting in COMEX-approved vaults that meets purity standards but has not been warranted for delivery. It belongs to ETFs, private investors, institutions who are just using the vault for storage. The exchange has no claim on it. So the real deliverable supply is that 103 million ounces of registered silver, maybe less by now, given the drainage rate. If this is making your head spin, smash that like button, because I promise you this is the most important thing you will learn about silver this month. Now let me tell you what happened in January, because this is the smoking gun. Total COMEX silver deliveries in 2025 hit 474 million ounces. That is more than double the 203 million delivered in 2024. Every single month in 2025 showed higher deliveries than the same month the year before. This was not a fluke. People stopped rolling their contracts forward. They started demanding real metal. Then January 2026 exploded. 49.4 million ounces delivered in what is normally a quiet month. That is 7 times the January 2024 level. In just 1 week in early January, 33.45 million ounces were physically withdrawn. 26% of registered inventory vanished in 7 days. And here is the detail that should keep the CME executives awake at night. February delivery data shows a 98% delivery rate. 18.72 million ounces delivered from 19.11 million ounces of open interest. Normally, futures markets see 5 to 20% standing for delivery. 98% is not a futures market anymore. That is a physical allocation mechanism. People are not trading paper. They are grabbing metal. Now let me connect this to the crash you just lived through. On January 29th, silver hit $121 per ounce. The very same day, the CME announced an 18% margin hike on silver futures. Kevin Warsh was nominated as the new Federal Reserve Chair, and Microsoft triggered a cross-asset liquidation cascade. Within hours, silver plummeted. By January 30th, it touched $84, nearly a 40% wipeout. The viral video told you algorithms triggered. That is true, but incomplete. Here is the forensic evidence they missed. When COMEX raises margins, leveraged traders must either deposit more cash or liquidate positions. Most cannot deposit more cash that quickly, so they are forced to sell. This creates cascading liquidation. Stop losses trigger. More selling, more stop losses. A death spiral in paper prices. The Hunt brothers experienced the exact same mechanism in 1980 when the COMEX changed the rules mid-game to crush the silver squeeze. But here is what makes 2026 different from 1980. While paper silver was crashing, the physical market told a completely different story. Shanghai silver premiums spiked to $14 over London during the January mania. The SLV ETF saw record inflows of $171 million on January 26th and 27th. People were not running from silver, they were running from paper silver to physical silver. Type I sold or I held in the comments right now. No shame either way, but I need you to understand what actually happened. The crash was not silver failing. It was the paper silver system cracking under the weight of its own leverage, while physical demand accelerated underneath it. So what happens next? I have 3 scenarios for you. Scenario Alpha, the controlled bleed, probability around 40%. This is the base case where COMEX manages the March delivery by convincing enough contract holders to roll forward or settle in cash at a premium. Registered inventory continues declining but does not hit zero. Silver consolidates between $75 and $90 through February and March. The paper physical divergence widens but does not break. This is what JP Morgan and Goldman Sachs are banking on. JP Morgan projects silver averaging $81 per ounce in 2026. This scenario requires that fewer than 20% of March contracts stand for delivery. Scenario Beta, the March squeeze, probability around 35%. If even 25% of March open interest demands physical delivery, COMEX needs over 100 million ounces. By first notice day on February 27th, at the current drainage rate of 785,000 ounces per day, registered inventory could fall to 85 million ounces. The math does not work. COMEX would face a delivery shortfall triggering emergency protocols, potential cash settlements, and a price explosion as the market reprices the scarcity premium. Silver could retest $100 and potentially spike toward $150. This is where the 356-to-1 ratio breaks in real time. Scenario Gamma, the slow grind higher, probability around 25%. March passes without a dramatic event, but the structural damage is done. China's export restrictions implemented January 1st, 2026, limiting silver exports to only 44 licensed companies, continue removing supply from global markets. The sixth consecutive year of structural silver deficit, projected at 200 million ounces for 2026, steadily erodes above-ground inventories. Silver grinds higher through the year toward $100 to $120 as industrial demand from solar, electric vehicles, and artificial intelligence data centers continues to accelerate. Bank of America's price target sits at $150. Now here is the question the viral video never answered. While retail traders were panicking on January 30th, who was on the other side of that trade? January 7th COMEX data revealed JP Morgan issuing 99% of 8.1 million ounces in delivery notices through 1,624 contracts. The same institutions that manage the paper system were taking physical delivery during the crash. Let that sink in. And it is not just American banks. The People's Bank of China continued its multi-month gold accumulation streak. Central banks globally bought over 1,000 tons of gold per year between 2022 and 2025, and emerging market central banks are now quietly adding silver to their reserves as a strategic and monetary asset. Meanwhile, the Shanghai Premium tells you everything. When silver in Shanghai trades at a $10 to $14 premium over London and New York, that means Eastern buyers are willing to pay significantly more for physical metal than the paper price says it is worth. Arbitrage should close that gap, but it cannot because there is not enough physical metal moving across borders to equalize the price. China made sure of that on January 1st when they reclassified silver as a strategic material. Here is what this means for you right now. If you hold physical silver in your hands, the paper price is increasingly irrelevant. Your metal is worth what someone will physically pay for it, and premiums at dealers remain elevated. The cost to buy physical silver right now is $8 to $10 per ounce above spot. The cost to sell is lower. That spread tells you physical demand is outstripping paper supply. If you hold paper silver through ETFs or futures, understand that you own a claim, not metal. The 356 to 1 ratio means there are 355 other claims competing with yours for the same ounce. In normal times, this does not matter. In March 2026, it might matter a great deal. And if you are on the sidelines wondering if you should buy at $79 when it was $121 2 weeks ago, consider this. The structural deficit has not changed. China's export restrictions have not changed. Industrial demand from solar and technology has not changed. The only thing that changed was the paper leverage got flushed. The fundamentals are stronger now than they were at $121. This is not financial advice. I am not a financial advisor. I am a forensic analyst showing you the data and letting you decide. Comment your silver price target for the end of February below. Are you buying at 79 or waiting for lower? Physical or paper? I want to hear your strategy. The March 1st notice date is February 27th. That is 14 days away. We will be covering every single development between now and then. If you found this forensic breakdown valuable, share this video with one other silver holder who needs to understand what 356 to 1 actually means before March arrives. Subscribe and hit that notification bell, because in the next 14 days, the silver market is going to give us the answer to the biggest question in commodity markets. Can the paper system survive when everyone demands the real thing? I will see you in the next dispatch.